Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. I'm Wendy McConnell. How are you guys?
Hey, Wendy. We're doing great.
Hey, Wendy. Yeah.
Hi, yeah.
Nice weather today. So.
Yeah, it's gorgeous today.
Spring
Getting
is
to be
here.
I should be on the golf course versus doing a podcast. That's my
Oh,
feelings. I'm not.
Well,
but
you know, I should be at the beach, so, you know.
Yeah, that too. That
there
works.
you go. So we have a guest today, I see.
Yes.
Yes, we do. We have Vincent Tassone from Causeway Securities. Hey, Vincent.
Hey, Vince.
Hey guys, great to be here. Thank you so much for having me.
Yeah, thanks for being on. I know you're a busy guy these days, so we appreciate you hopping on here.
Absolutely.
So you'll maybe give a little bit of your background, Vince, and then we can get into a little bit of what we're going to talk about today, more being structured notes, which I've been excited to really talk about this because I think it's a topic that not a lot of our listeners have heard of before. But before we get into that, give a little bit of your background and how you got to where you're at here at Causeway.
Absolutely. It's a pleasure. So, grew up in South Jersey, the son of an immigrant father, true American, American dream story. Met my mother here, who's from the Philadelphia area for a couple generations, and grew up in a small family business. So my family has a small pizza shop in West Deptford, New Jersey. Vinny's Pizza. We've been there since 1996. And, I think that had such a profound impact on my upbringing and kind of passion for business. I love that Copper Beech is here in South Jersey. So, of course, I've known both of you for the better part of the last 6 years and loved the fact that, here I am back in New Jersey after starting my career in Chicago. So I did go to Rutgers in Camden, graduated in 2015, started my career in asset management back in 2019 in Chicago, also covered Virginia, West Virginia, but I've only ever called on financial advisors and only ever served the financial advising community, for a bulk of my career in asset management. So it's a pleasure to be here and be a resource. Quick backdrop on Causeway Securities. So we're one of the largest independent structured note distributors in the world. We do have global operations and are headquartered in Belfast. But, it's a great pleasure to be here with you guys and look forward to, discussing everything structured note related.
Yeah, well, thanks for that. Let's get into it. So why don't we start with just the very basics is what is a structured note?
So a structured note is a financial instrument that combines a bond with a derivative to offer customized risk return profiles. I know that kind of sounds like a pretty basic response, and it's a lot more complex and complicated than just that. But the basic understanding for people to know is that a structured note is simply a bond with a derivatives options package, really designed to be able to allow investors to customize their own specific risk return profile.
Yeah, this is it's an asset class that not a lot of people are used to hearing about. I think most people have heard about stocks, bonds, real estate, asset classes like that. Structured notes are obviously a little bit different from that, and you gave a great example.
Exotic product, right? That's how I refer to it.
Yeah.
That's exactly right. So, I mean, they're definitely complex, and we obviously suggest that folks that are entertaining the idea of implementing the strategy work through a financial advisor because of the complexity. And that's why, we suggest people working with professionals like you guys who know their specific risk return profiles and then can match that within a particular strategy.
Yeah, I know that these are not products for every investor, correct? I mean, you have to be an accredited investor typically to purchase one of these products, or is that too strict of a definition?
Well, actually, so the minimums on structured notes are actually quite low from most of the issuers. So these are always issued by a third party, an investment bank. But some of the issuers actually have quite low minimums for structured notes of only $1,000. So the suitability is something that we definitely see financial advisors handle more so than the distributor. The way that we add value is definitely by being a consultative resource for the advisor. But the suitability is definitely something that is relevant and something that is typically and most often addressed by the FA.
All right, so Vince, great having you, my friend. So as an investor, why would one want to buy a structured note, and where would that fit in a portfolio from an asset allocation standpoint? With a minimum of $1,000, that's pretty low. So where would that fit in an average portfolio? And again, why would someone invest into a structured note? What's the benefit? Big benefit.
Yeah, John, I think this is a great segue to talk about the different types of structured notes that exist. So one of the greatest parts about the asset class is that there's a solution for a lot of different risk profiles and objectives. So there's principal protected notes, there's income notes, there's growth notes,
Right.
And there's even dual directional notes that we see people use as more of a hedging or an insurance policy of sorts, within their investment account or portfolio. So it really depends on what the client wants to achieve. But we can walk through some of the examples of the different note types and then kind of match those to client profiles, right? So some of our more conservative clients, they're typically using the principal protected strategies, and the name kind of explains what it is, right? Principal protection. These are backed by the issuing firm. And so the target is to have 100% principal protection. And for that reason, you're giving up some type of performance on the upside, typical risk return dynamics at play. But so those are typically structures where the client can customize the tenor on all structured notes. So instead of them being locked up for a 5-year commitment or a 7-year commitment, like some of the other so-called guaranteed strategies, sometimes folks will actually do an 18-month or a 24-month principal protected note. That way they're locked up for a lot less time, if that makes sense. There's more of a liquidity component there. Some of the more popular strategies are definitely the income producing ones. So there's two major elements in all income strategies, either auto callable or issuer callable, meaning that in the auto callable format, that the strategy will be called away if the underlying indices or securities are flat or positive at the observation date. The issuer callable strategies, of course, per the name, leaves the callability up to the issuer. But typically, our advisors are using these to design custom targeted income levels for their clients. And one of the key features with all structured notes is that the underlying securities can really be up to the investor. So it's not rare for us to see people use plain vanilla indices, S&P, NASDAQ, Russell, Dow, or you can use individual stocks. And so we do some single stock or worst of 3 stock baskets. But ultimately, the goal in those income strategies is always to achieve some particular targeted level of income.
Vince, real quick, I mean, that opens the gate for a couple of things for me. So if I wanted to work with a client, wanted to design a strategy in their portfolio, I could pretty much design the income that I'm looking for. And if it's a growth portfolio, I could pretty much design the growth opportunity in that design. And the other question is, who issues these notes? Who's the issuer in these notes typically?
Yeah, those are great questions. So, and you're exactly right. I think that's why the asset class has become so, increasingly popular, is because of the customization element. So on the income side, you can attempt to achieve a specific level of income, and then in return you're getting different levels of principal protection and coupon protection. So without getting too deep into the weeds, of course, the main element there is that the strategies are fully customizable, and it gives the advisor the ability to be consultative to their client and really take into consideration their particular risk return profile, and then match that with a specific structured investment.
Yeah, I mean, just to kind of edge that out a little bit. So if I had a client that was in a retirement mode and said he's looking for a 7% rate of return because that's what he needs to pay his bills on a monthly basis, you could take that goal and structure these notes with safety around it. Am I correct?
That's exactly right. And you can even target a specific level of return. It's not rare for some of our clients to say, look, I would like to solve for the deepest level of principal protection that I can achieve while targeting a 6% or a 7% return, as you mentioned. That again, on the growth side as well, you can seek to achieve the maximum level of potential upside performance. And of course, there's risk involved, right? So it's this constant kind of dynamic of risk and return, but you can customize them to achieve what you want. To answer your question about the issuers, so structured investments are issued by most of the major investment banks in the world. So Causeway Securities serves as an independent distributor for the investment banks that we're strategically partnered with. So a lot of these names are household names that most people are familiar with: J.P. Morgan, Barclays, so on and so forth. But the nice thing is that we can then go in and communicate with the investment banks to try to achieve some level of understanding of what they can provide to the client in the format of a structured note, and then let the advisor decide which specific strategy that they'd like to implement.
All right, so I'll get back to that portfolio again. So you would take that information from me and Michael or another advisor, and let's say I'm going to build a 7% return portfolio with a structured note. You would shop it around all these third parties and get the best program issued by either one of these parties. I'm assuming it's pretty competitive if you get right down to it. Am I correct?
Very, very competitive. And look, we would take a deeper dive even than that. We would say, look, what is it that the client wants to achieve, and what are they willing to kind of toggle, so to speak, to achieve that desired outcome. And so if they said, look, I want to target 5%, then that the risk return profile on a 5% income target is going to look a lot different than someone who's targeting 14% or 16% or 18%. Of course, that's, I think, what financial advisors do best, is that you all know your clients very well, right, and you know exactly what is important to them. I'll give you another customization element there. You can actually customize the timing of the income payments. So some of the auto callable income notes or issuer callable income notes, some of them have a monthly or a quarterly or semi-annual income distribution. Now, if you're a client that's in an extremely high tax bracket, you may not want ordinary income tax on a 5 or 10 or $15 million position that's yielding you 5 to 7%. So we actually have the ability to build what's called a digital note, where the income payment actually gets distributed 12 months in a day. So it's treated as a long-term capital gain as opposed to being treated as ordinary income.
Yeah, that's really interesting, Vince. So one thing, when you were talking about the issuers, if maybe you can go back to that for a second. And this has come up not specifically with this structured note issue, but oftentimes in the private credit market, when you start talking about sort of income notes where you're targeting 15, 16% potentially income levels, what's in it for the issuer? Why do they structure these products to provide this potential benefit to the client?
Yeah, it's a great question. So there's a few obvious benefits to the issuer, of course. So this is a way for a lot of the major investment banks to actually raise capital. Don't forget the core component of a structured note is the zero coupon bond, right? So it's a great way for the issuers to raise capital on their end. But of course, like any investment strategies, there are fees involved, and so they do earn a fee for kind of putting together the portfolio and structuring the investment for you. One thing that's important to note is that each individual strategy has its own unique CUSIP and prospectus. So it is a way, again, for advisors, not to be redundant here, but to build a truly custom portfolio for their clients that results in their own custom prospectus and custom CUSIP. And so, of course, you can imagine the fees that are involved, to think about even what it would cost to pay a lawyer to kind of write up the prospectus. So,
Right.
of course, those are some of the fees that are involved. But I think that the customization element, you kind of think of it almost like getting a tailored suit versus getting something off the rack.
Right.
And so most of the clients are kind of comfortable with the fees, and of course there has to be transparency, but most people are more so focused on the outcome and the targeting of that outcome than actually the net cost.
Sure. That callable feature that you alluded to briefly before, can you explain a little bit how that works? Is that where the issuer can call the note and effectively take it back? Am I correct in that?
That's exactly right. So all of the structured notes on the market have a fixed lifespan. And so most of the formats are, 3-year, 5-year, 7-year. In Europe, this is something I learned, that in Europe, sometimes they're longer dated strategies. So they're more 10-year, 15-year structures. But as with any bond, there tends to be a callability feature. So the issuers do maintain the right to call the instrument back. And again, that's completely customizable. There's actually non-callable notes as well. So if you don't want them to have the ability to call it, most issuers will let you kind of work that into the strategy. But what do you give up for that? You're probably going to not have so great of terms on that strategy, right? So you may give up a bit on the income side compared to a callable note. Yeah. But the way it works is, look, let's just say we put together a 3 or a 5-year income note that was non-callable for 3 months. So 3 months goes by. Let's just assume it's a monthly observation and a monthly income distribution. If the underlying securities have not breached their potential threshold, then the client gets an income payment. That series goes on up until the observation date. The observation date comes and the underlying securities are flat or positive. That, in an auto call format, will automatically get called away back to the issuer. In the issuer callable format, of course, per the name, the issuer maintains that right to either leave the note out there or call it away in the same way that it would get called in an auto call format.
Hey, Vincent, again, getting back to the investor, I always stay on their side. And I look at things a little like, how does it hurt me? How does it help me? From a how does it help me if I do a 5-year structured note and all of a sudden I need liquidity and I need to cash that in, as an example? Is there a fee, penalty? How does that work from a liquidity standpoint?
Yeah, so these are typically strategy by strategy. There's certain terms. Don't forget, I mean, every prospectus is unique to itself. So some of them have early termination clauses. Some market linked CDs, for example, have a death put that can be exercised. At the discretion of who inherits the structured note. But from a liquidity standpoint, they are designed to be held to maturity. So there could be losses in the strategy. And some of this for you guys, of course, that are true annuity experts, right? This probably sounds familiar, right? I mean, sometimes early termination fees or there could be losses. Sometimes there could be a gain in the strategy as well. So in the event that a client were to pass away, if the investment has a gain in it, it may be a wise decision to just hold it to maturity.
Yeah, and as you know, Vince, we deal a lot of trust structures, and we look at 100-year families. I know you've heard that term before. So we look at these strategies as a component of a trust design where they're long-term for kids and grandkids. So you could probably build and should build a structured note diversified type of portfolio where you have some notes to produce an income, some notes for aggressive growth or growth, and combine them since the minimums are $1,000. Couldn't you build a dynamic portfolio using these notes for that long-term perspective and being diversified?
Absolutely. Absolutely. In fact, there are some asset managers who have actually designed structured product SMAs. And so they've actually taken separately managed accounts where they'll build structured note portfolios that, again, to the point you hit the nail on the head, they're going to have a desired stated investment objectives. So they'll have income portfolios, they'll have growth, they'll have aggressive growth. And some of those can even go, of course, client by client. I think that's a perfect segue to speak a little bit about the dual directional strategies, which have been definitely popular this year with the volatility in the market. So these structures are such that, per the name, if the index is down, the investment strategy may actually have net positive performance. So let's just take a hypothetical 13-month dual directional note tied to SPX. Let's say that in 13 months or 15 months, whatever the term on the strategy is, the S&P is down 10% in a 10% buffer strategy. This strategy would actually be up 10% in that world. And so some of our clients look at this as a way to maximize and enhance risk return metrics. Of course, most of the portfolio managers out there track to Sharpe ratio, risk adjusted returns. You can imagine what the Sharpe ratio would be on a portfolio that held a strategy that was actually net positive when the broad market is down.
So today's marketplace, again, being after a 15-year bull market, I know we're getting a little adjustment these days of a few percents, but you could probably look at this product decision as the hedge against the downside of the market. Would that be is that a push for you guys currently, or is that something that I'm just thinking about?
That's exactly right. I think, look, being someone who's really spent a bulk of his career focusing on serving financial advisors, a lot of what we build is driven by demand that we get from advisors. And so definitely less about what we think about the market and more about what you all think and what your clients think and what's appropriate for your clients. And of course, going into a year where the last 2 years were so great, a lot of people were looking to take risk off the table and wanted to prepare for an environment with heightened volatility and heightened uncertainty, right? We're coming into a new term for a new president, right? So trade wars, tariffs, all these things, people were looking to potentially take a little bit of risk off the table while still remaining invested in something that does have a growth component. And so that's the element there with the dual directional strategies. If you have participation rate down to a particular buffer, you have an inverse return down to that buffer. So let's just say, again, if it was a dual directional tied to the NASDAQ with a 20% absolute return buffer, right? And the NASDAQ goes down 15%, you have the potential to be up 15. Or again, there could be a cap on the strategy, right? So maybe the NASDAQ is down 15 and you're only up 9, right? But these are the way that the absolute return notes can help people in an environment with heightened volatility.
Vincent, like that example, how does that differ from like selling short a stock? Is it because it's on the index itself? I guess you could be short the index as well. I'm just trying to, for those listeners and maybe you're not familiar with that, or maybe like how is this different than just I'm just going to go short the S&P 500?
Yeah, so because of the derivatives package, because of the options package, they're able to design a structure where you have potential upside during an environment where the underlying is actually down. So you think about the nature of a short position where the person who's putting on the short is only positive in the world where that underlying security is down, right? But in a very different way. They're borrowing, right?
Yeah.
They're so it's very different from structuring just a pure derivatives package. And of course, as I mentioned, not to be redundant here, but all structured notes are simply a zero coupon bond with an options package.
Okay. Yeah. Thank
So
you.
very different from the process in a short sale.
Yeah, I mean, logic would be, and I guess that's just how I think, is that why wouldn't everyone have that type of strategy in their portfolio to protect the downside when it does occur? We know it occurs. So if you wanted to have a growth strategy in your portfolio and you had maybe $50,000 to invest, you put $25,000 in a structured note with the downside protection and $25,000 in the S&P 500 or some type of an index that's growth oriented. Would that make sense, or am I thinking
Absolutely.
different?
Absolutely. I mean, look, we think that, again, that's the power that the financial advisor has in every situation, is that they know the client, they know what's suitable. Of course, with structured products definitely being a very complex asset class, that's why it requires the expertise of a financial advisor to make that call and to kind of understand what the allocation weights should be for each client. So in your example, 50% may be too high for most people, but for a very kind of accredited investor or somebody ultra high net worth, very experienced investor, maybe they're comfortable with a higher allocation weight. But that's the power with which we can't stress enough, that's the power of working with a financial advisor. I mean, somebody that knows not only your situation, but think about, like, I love what you all do at Copper Beach with the 100-year family concept, where it's like, look, the current investor may be very experienced. They may be very knowledgeable.
Right.
It may be okay for them to have a large allocation weight to complex strategies. But what about their beneficiaries, right? I mean, do those folks have the same level of knowledge, the same investment acumen, so to speak? And so that is a huge consideration. And those are the things that, again, being on the more asset management, investment management side, that we don't see as much as, of course, folks like you do.
Sure. Yeah. Vince, we're huge fans of case studies. I don't know if that's something we kind of put you on the spot here with that, but is there like a case study of I know you work directly with the financial advisor, but maybe they approached you with a particular client need and situation, and how you guys helped with that? Is that possible?
Yeah, that's a great question. And I'm no stranger to being put on the spot, that's for sure. So all good. And look, there's so much research, and we have so many great partners on the research side. I mean, even the issuers specifically, I mean, they have so much data, and some of the third-party data firms out there as well, where, I can't think of one off the top of my head, but I definitely know that what you're looking for exists in the format of some kind of case study, and even just data analytics. And one thing that I'll bring up here, just because you mentioned it, there's a firm that we work closely with that actually helps advisors optimize the security selection in the structured note world. And so where that came from is like this world where advisors were really relying on their gut instinct to determine which underlying securities use S&P, NASDAQ, Russell, these kind of plain vanilla broad indices. But on the single stock side, you can imagine how many different stocks there are to pick from. So it's like, if you're an advisor, what do you use, right? And so there are AI-empowered platforms and solutions that actually help the advisors pick the underlying securities. So I know that was probably a little bit of a tangent off of your question.
No,
but
AI is part of the equation going forward. It's going to change every day. So we get that. That's going to be important focus going down the road. No doubt.
Yeah.
No doubt.
Well, Vince, I think fortunately we could talk here all day, but I think we're running out of time here. But I want to thank you again for joining us here today. Is there anything we didn't cover that you'd like before we hop off here to have our listeners understand about what you guys do at Causeway and structured notes in general?
No, I think we covered a great deal. Of course, the challenge is in the complexity, and so sometimes even us in the investment management world, where there's so much jargon and there's so much terminology that you want to make sure that you're citing everything the right way. But I think that the beauty of what financial advisors do is that you kind of cut through a lot of the jargon and you explain it in a way where people can understand it and ultimately influence them to make the right decision based on their situation. So I can't say enough good things about you all and Copper Beech and what you've built. It's had an impact on me and how I operate in my family. Thinking about things in terms of generational wealth and not just
He listened, Michael.
Apparently,
he listened to it.
Apparently,
was that over a bottle of wine that night, Vince? I can't remember what night it was.
That's right. That's right. I think also just I'm happy that I got to tell my story a little bit too. But just coming from a family that owned a business, right? And so you're thinking, look, I mean, it's not just about you. It's about the people that are working with you. It's about their families. Like, what does that look like in generation 2 and generation 3?
Yeah, that's our world. Yep.
So. But that might be a topic for the next podcast.
Absolutely.
Yeah, I'd love to have you on again. Yeah, well, thanks again.
Hey, Vince, thanks, buddy. Always appreciate it. Good seeing you, my friend.
So, Michael, tell us, how do we get in touch with you guys if somebody has more questions?
Well, you can reach out to us on LinkedIn. Copper Beech has a LinkedIn page, or you can go to our website, www.cbfgllc.com.
All right. Thank you so much, guys, and thank you for listening today. Please follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.